Hello guys, welcome back to another YouTube video. So this is the ultimate forex trading course for beginners. So if you're a trader and you've been trying to get into this industry, the forex industry, and you want to learn how to trade forex, this is the video for you guys. And also, if you have been in the forex market for a long time and you haven't been able to understand most of these things, the candlestick patterns and all that, this is the video for you guys. So make sure to watch this video from the start to the end, because I'm going to be explaining from A to Z, from the basics to technical analysis, guys. So without further ado, make sure to subscribe to this channel and let's get started with this video. What is forex? So forex, first of all, forex stands for foreign exchange. So we are simply exchanging one currency for another. That's what forex means. We are dealing with currencies. Like even though you have to travel, you have to have currencies to exchange currencies to the country you're going to. Let's say if you ever travel to another country, let's say if you go to the United States, you'll have to exchange your money from Uganda shillings to the United States dollar. So when you reach into the US, so that you can be able to use your money there. So that's all for trading. Even though you have gone to Dubai, you have to exchange your Ugandan shillings to the Dubai money, which is the dirhams. So that you are able to use your money in that country. That's all forex trading. So literally everyone has participated in forex trading. So forex trading is just basically we're exchanging one currency for another. And one example is when you travel out to another country, even when someone sends you money. So sometimes when they send you money in dollars, or someone, let's say if they give you in dollars, you have to go to the forex bureau so that you can exchange your money. So that is forex trading. Then the forex market has a liquidity of $6.6 trillion. This is the biggest financial market in the world. This is how much is being traded every day. You see these numbers are so big. So meaning the forex market is very big, so it's a very good industry to be in or to trade in. So if you're a forex trader, you should know this. It has a liquidity of $6.6 trillion. So this is the biggest market, bigger than the New York stock market, bigger than the London market combined. Because the London market, the New York stock market has a liquidity of $25 billion that is being traded every day. But as you can see here, this is $6.6 trillion. So who trade in the forex market? So we need to know who trade in the forex market also, because people, you may think it's just we traders, but also the other institutions involved. Like the biggest institution is the central banks. Central banks trade in the market. So whenever they want to buy certain goods for their country, or they want to receive a certain product, they'll have to exchange huge amounts to any amount they want, so that they can be able to buy or export goods and all that. So this is the central banks. Then we also have commercial banks. Commercial banks, these are the banks where you guys go and create accounts. You save your money there. So what money that you save in this commercial bank, that's the money that is being traded by in the forex market. Then you have, these are corporations, these are companies. Like these big companies, like the hedge funds, they all fall under this here. Then there are the brokers. So the brokers are these companies where you put your money and then you want to trade through. So also the brokers trade in the forex market. The brokers. Then also there is me here, the retail traders. Me and you are retail traders. So these are all institutions and people that are involved in the forex market. So if you're trading the market, you should know it's not only you in the market. This actually forex market is a very, very big thing, and people don't know about that. They think it's just gambling. Most people think forex is gambling, but as you have seen, central banks trade in the forex market. Each country has a central bank. Every country has a central bank, so they participate in forex trading. Some to commercial banks, So guys, we need to wake up and know that the forex market is a very big thing. So let's jump on to the next thing. So these are some of the advantages for trading forex. So first of all, high liquidity. As I've told you, there is so much money. You have a volume of $6.6 trillion, $6.6 trillion that is being traded every day in the forex market. So meaning there is much money. We can't even finish that money. So there is much money in the market and it's going nowhere. All we have to do is just get our skill up, and then we can be able to make money in the forex market. The other thing is you can start with as little as $100. Yes, when you learn how to trade forex and you get your skill up, you can start with as little as $100. Because with $100 and you choose a good leverage, your broker will offer you huge amounts in units, almost like 10,000 units, so that you're able to control huge amounts of money with just less money. So you can start with as less as $100 in the Forex market. Then the market is open 24/5, so that you can trade anytime you want. You see, market is open 24/5, so that you can trade anytime you want. So this means most of you guys hear about 24/7. 24/7 means the 24. It's open 7 days a week, 24 hours a day. But now this is 24/5. 24/5, it means it's open 24 hours a day, but 5 days a week. So the Forex market is open 5 days a week and it's closed on Sunday and Saturday. So you can trade anytime you want. There are no restrictions on when to make money and when not to make money. So also we need to know about the Forex trading times. We need to know about the Forex trading time. So we have, these are like the major markets. We have the Sydney market, we have the Tokyo market, we have the London market, and the New York market. So the Sydney market, it opens up at 21:00 GM time, and it closes at 5. Then the Tokyo market, it opens at 23:00 and then closes at 7. Then the London session, it opens at 7 GM time and closes at 15 GM time in the evening. Then the New York market, it opens at 12 and closes at 20 GM time. So I've already done a video on how you can see if you're in Uganda. If you want to know what are these times in our own time, like African zone, you can check out that video. So these are like market sessions, but not all these market sessions are very, very volatile. So the best market sessions to trade on is the London session and New York session. So when this market is open, you can make more money. Even the New York session is open, you can make more money. But where is the most money is when both the London session and New York session is open. So between 12 and 15, between this time here, you see this time here, this is when there is the overlap. It's when the London session and New York session are open. So that's why you see the most news coming out. Markets are very volatile. So those are the best times to trade in. Then also we shall jump onto a currency pair, because remember we are trading currencies, so we need to know what is a currency. Because remember, we can't just trade we can't trade just one currency. We have to pair them to form a currency pair. So what is a currency pair? A currency pair is just a quotation of two different currencies with one value of the other being quoted against the other. So here, let's say we have Euro USD. So one value of this one is being quoted against the other, so meaning it's euro versus the dollar. So the value of one currency is being quoted against the other. So let's say this is Euro USD. So since our Euro USD is our example, and this is now our currency pair, Euro USD. So the first currency in pink, the euro, is the best currency. So the best currency is the first currency of any currency pair. Then the second one, which is the US dollar, on your right hand, this one, this is the quote currency, and the quote currency is the second currency pair of any currency pair. Then we have also different types of currency pairs. We have the major currency pairs, cross currency pairs, and exotic currency pairs. So most times when you guys are in the Forex markets, or when other traders in the Forex market, they tend to trade without knowing, okay, these are major or these are cross. So I'm going to be showing you the major, the cross, the exotic pairs, so that now you know that, okay, I'm trading now an exotic pair, I'm trading a major pair. So the major pairs are, these are the most traded currencies in the currency pairs in the world. So we have Euro USD, we have GBP USD, we have USD CAD, we have USD JPY, we have USD CHF, we have AUD USD, and New Zealand dollar USD. So these are the major currencies. So if you're a trader and you're looking to make money with this pair, with trading Forex, you don't have to trade every currency pair. Just look out for a few on these most traded currencies, because these are the major ones. So we jump onto the cross currency pairs. So these are the ones that don't have the US dollar. So like euro crosses. So we have euro GBP, we have euro AUD, we have euro NZD. So those are the euro crosses. Then you have also the pound crosses. So the GBP JPY, GBP AUD, GBP NZD. Then we have also the yen crosses, AUD JPY, NZ JPY, and GBP JPY. So these are cross pairs. These are cross currency pairs. Then from here we have the exotic pairs. These are the exotic pairs. We even have more. So when one major currency is paired with a developing country's pair, that one is called an exotic pair. So like we have USD Mexican peso. This is USD Mexican peso. Then here we have Euro Tri. So this is the Turkish lira. Euro Turkish lira, this one. Then we have the Indian rupee and GBP. Indian rupee, GBP. So these are exotic pairs. These are called exotic pairs. Then from there we have what is a pip. What is a pip? So for us to know what a pip is, we need to know about we need to have an example. So before that, we need to know what a pip. A pip is the measurement to express the change in value between two currencies. That is called a pip. So let's say we have Euro USD. So if our Euro USD goes from 1.1050 to 1.1051, so meaning our Euro USD moved from 1.1050 to 1.1051. So that 0.0001 USD rise in value is 1 pip. So meaning the pip value, the pip change here was only 1 pip. Market moved 1 pip. It changed 1 pip. So, and mostly pips are always the difference, these last digits here. So whenever this number changes, as you can see, this number changed from 50 to 51, meaning market moved 1 pip. So then we jump onto what is leverage. So these are all how should I say this? These are all the things that have to stick on your fingertips. You need to know what is a pip, then you need also to know what is leverage. So leverage is just the ratio of the amount capital used in the transaction to the required saturated deposit. So it may look complex, but let me break it down for you. So it's the ability to control large dollar amounts of a security with a relatively small amount of capital. So let's say you have deposited $100 in your account, then you choose a leverage of 1 to 100. It means your broker is going to offer you 10,000 units in money. So with just $100, you're able to control large amounts of money. So you can make big money, and sometimes also you can lose money, because the leverage is a double-edged sword. It gives you money, sometimes it takes money from you. Yeah. So then leverage varies dramatically with different brokers, ranging from 1 to 1 to 500 to 1. So the leverage that I recommend is 1 to 300 leverage, or even 1 to 200, also 1 to 100. Then here they'll give us an example. So if you use a leverage of 1 to 300 and you had a capital of $1, you would take a trade worth $300. But however, remember, it's a double-edged sword. So basically it allows you to invest more than you have in your account, but remember, it's a double-edged sword, meaning it can give you money, sometimes it can take money from you, because it's a double-edged sword. It takes and it gives. So that is what leverage is. Then we have what is a lot size. So the lot size is the number of currency units you buy or sell. So there are standard lot sizes, mini lots, micro lots, and nano lots. Most of you guys just use these lot sizes 0.01, 0.10, without knowing that, okay, this is a micro lot size, this is a mini lot size. And also these lot sizes require you to have a certain amount of money in your account to trade them. So let's say these are now our lot sizes. So the nano lot size, which is 0.001, it contains 100 units. Then the micro, which is 0.01, it contains 1,000 units. Then the mini lot size, which is 0.10, it contains 10,000 units. Then the standard lot size, this is the standard lot size, which is very big, it contains 100,000 units. So meaning we needed to have, for you to use the standard lot size, you need to have $100,000 in your account. But again, since we have leverage, all you need for you to trade 100,000 units, you only need to deposit $1,000, and you are able to trade with 100,000 units. You'll be able to control this much. So leverage, this is where leverage comes in and helps us, that even with less money, we can be able to control these huge amounts of money. So this is what these are some of the amounts you needed for you to trade with these lot sizes. The nano, you needed $100. Then the micro, you needed $1,000. Then the this is then the 0.10, which is the mini, 10,000. Then with the standard lot size, which is one, you needed $100,000, but with the leverage, we don't need to have that much in our accounts. Then we need to know about the pip value. So since that we know that if market moves, it changes, like from here. Let me show you. If market moves, since your market moved 1 pip, I'm going now to show you what is 1 pip worth. So I'm going to show you what 1 pip can give you. So with 1 pip, when you use a nano lot size, it will give you $0.01. And then when you use the micro lot size, it will give you 1 cent per pip. But when you use the mini lot size, it will give you $1 per pip, and the standard lot size, it will give you $10 per pip. So when you're using these lot sizes, you have to be very careful, because they are also double-edged sword. The bigger the lot size, the more money you make, and the more money that can be taken away from your account if the trade goes against you. So, and if you're a beginner trader, I recommend you to use these micro lot size and below. I recommend you to use the 0.10 mini lot size and below. So actually, you're not over risking, but you're trying to develop your skill. But some people, you tend to use these big lot size on their demo account, and then they trade with those big ones. They trade, but when they come to their real accounts, they can't use these big numbers. So that's where the problem comes in. So you should know that these people, the more pips, the more money. So then we jump on to risk management. So when you're trading in the Forex market, even in our daily life, we need to have risk management. So what is risk management? So risk management refers to implementing a set of rules and measures to ensure any negative impact of a Forex trade is manageable. So here in Forex trading, the biggest thing that all professional traders have, at least they're able to control their risk. Beginner traders, they want to control the Forex market, but professional traders want to control their risk management. So if you are able to control your risk management, that is a very good thing, because you won't be able to lose money. But if you want to control the whole market, it means you're not controlling your risk management. So I'm going to give you an example. So even when you have a winning strategy, but without proper risk management, you will still lose, and this is very common. Most of the traders DM me and they told me I have a very good strategy, but I'm not profitable. This, and very many text me that. But the only problem is their risk management is very poor, because even though you have a good strategy that works, but when your risk management is poor, you can't make any money in the Forex market. So get your risk management well. But I'm going to give you an example here. So here we have two diagrams. So we have this someone. So this one is taking small steps, but again he's up there. But again we have also this lady here taking big steps, but she can't jump onto the other ones because the steps are so big. So it's the same as Forex. So most of the Forex traders, when they come into the market, they want to over risk. So this is over risking. They over risk and they close losses randomly. This is how much they lose. So they reach a time where they can't go even any further. But now, since this one risks small, I mean they have a stop loss and then they have a certain target they are willing to lose. Still, when they lose, they have a target they lose, but when they hit profits, it takes them up like this, you see. But again, when you don't have a stop loss, you close randomly, you blow up your account. But here you won't blow up your account because you have a stop loss, you keep on going up. So that's why a stop loss is very vital, and risk management. Then from there we jump onto the market orders. We have market orders. So a market order is an order to buy and sell, or sell at the current market price. That's what the market order means. If it's a buy, it means you're buying at the current market price. If it's a sell, it means you're selling at the current market price. So let's say the Euro USD is currently trading at 1.2140, and the ask price is 1.242. So if you wanted to buy at the exact price, you would click buy, and your trading platform would instantly execute the buy order at the exact price. So it means if you want to buy to buy at the current market price, you just press buy on your MT4 or on your MT5. But if you want to sell, it means you just press sell. So if you press sell like this, it means you have sold or bought at the current market price. That's what the market orders mean. Then from there we have the limit order. The limit order. A buy limit is an order placed to buy at a certain price. So these limit orders, these are future executions, or these are future orders. So let's say when you want to price to come at a certain level, and then when it reaches a certain level you want to buy. So let's say if price comes, this is coming from down here, it comes to this zone, this green zone. So let's say you set your buy limit here. So when price reaches this buy limit, it just go back up. So I'll give you yeah. So if price is at this, let's say price is currently trading at this blue dot here, then you think it will reach this zone here and then go up. So you would set your buy limit here. So when price reaches here, it automatically execute itself and go up. But still, when you're using a buy limit, you have to set your stop loss. Then a sell limit is another place to sell at a certain price. So this is our sell limit. So a sell limit is just the opposite of the buy limit. So let's say if price is trending at the current blue zone here, then you think it's to reach that red zone there and then bounce off and reverse and go down. So meaning here you'd set your sell limit that when price comes, taps there, you just go down and you take you in profit. So whenever price reaches your buy limit or sell limit, the trade automatically executes itself. Then from there we jump onto the stop orders. So the stop order, we have the buy stop. So a buy stop is an order to buy at a higher price than the current market price. So for this one, this is what they mean. So let's say if we have price jumping, trending below this green line and price is currently at this blue dot. So if you want to trade in this market and you just want to trade on to buy at a higher price than the current market price, so meaning the current market price is this blue dot, so meaning you'd set your buy stop above, so that when price just passes through your entry or your buy stop, it will just go into profits because you think price will just keep on going. As you see this small illustration, that's what the buy stop means. Then from there we have the sell stop. So a sell stop is an order to sell at a lower price than the current market price. So this is just the opposite of the buy stop. So let's say if price is selling at this blue dot and then you think it will reach this red zone and just keep on going, so you would put your sell stop at that red zone. So when price reaches this zone here, it will just keep on going, down, and it will take you in profit. So all these sell stops and buy stops and then sell limit and buy limit, these are all future orders. They execute themselves as long as price reaches your desired point. Then you also have the stop loss order. So the stop loss order is a limit order linked to an open trade for a purpose of preventing additional losses if your price goes against you. So if let's say you have a trade and you have placed a trade and then you're running losses, so most times we use a stop loss to stop us from blowing up all our accounts. That's why I always advise people to use a stop loss, because it's very vital. You have to use a stop loss, so that when the price goes against you, it doesn't take you out. You just lose a certain figure. As you can even see, a stop loss order remains in effect until the position is liquidated, or you cancel this stop loss order. So stop loss is very good, guys. Don't forget to use the stop loss because it's part of the risk management. From there we jump onto the two prices in the market. So we have these two prices in the market. We have the bid price and ask price. So the bid price is the price at which you sell, and the ask price is the price at which you buy at. So this is our example. We have Euro USD. So we have the bid and then ask. Remember, the bid is the price you sell at and ask is the price you can buy at. So meaning if you have bid here, so if you want to sell euros, this is how much you have to pay in dollars. You have to pay $1, 4 cents 502. But if you want to buy, which is the ask price, it means you want to buy €1 for $1, so you have to pay $1 for 45.05. So this is how much. So this is what we say about the bid and ask. If you're selling euros, this is how much you sell euros for. This is how much in dollars you pay. But if you have to buy euros in dollars, this is how much you have to pay so that you can receive €1. So that's the bid and ask. So those are two prices we have. Then as you can see here, this is the Apple stock, but still even the Apple stock has the bid and ask price. So this here, the in red, is the ask price. It's the this is the ask price here in blue, and this is the bid price. Remember, bid means sell and this means buy. So this is these two prices here we have here for the Apple stock. So this is my trading view. Then we have spread. What is a spread? So a spread is the difference between the bid and ask price. So we shall come back to this graph here. So you see they have told us it's a difference between the bid and ask price. So since this is the ask price and this is the bid, this number you see right here, you see this number, this is the spread. This is the spread. So the bigger the spread, the more money the brokerage takes from you. So as you see, this is Euro USD. So this is our ask price and this is the bid price. So this spread is more of a transaction cost. It's more of a transaction cost. So whenever you open up an account with the broker, they offer you you deposit your money to trade. So you have to trade these currencies, and all these currencies have spreads. So this spreads, when you come onto your trading view, you see the spread in between here. So the bigger the spread, the more money the brokerage takes from you, or the more money for your transaction cost. So whenever you place a transaction or whenever you place a trade, that spread is like a transaction cost. So we want our spread to be small. As you can see, the bigger the spread, the bigger your transaction cost. So how do we reduce the spread? So we love to trade with we want to make money, so we want the spread to be so big. So one of the ways we can reduce the cost of the spread is focus on major currencies. When you focus on these major currencies have small spreads. So like Euro USD, GBP USD, AUD USD. So these are major currencies. They have small spreads. Then also trade the higher time frame, so the cost of your spread is lower. So this is very good. When you're trading on the bigger time frames, the cost of your spread is smaller. But if you're trading on the smaller time frames, the cost of your spread is high. And also the other thing, look out for brokers that offer good spreads. The broker I'm using is Xness. Check the link below and sign up with Xness. And before you go any further, make sure to subscribe and let's continue with this video. So we have types of traders. So we have different types of traders. So we have the short-term traders, medium-term traders, and long-term traders. So we shall start with the short-term traders. So what are short-term traders? Short-term traders are traders that trade on small time frames, below 1 hour, 1 hour and below. These are traders that they only target 50 pips, 5 to 50 pips in the market, and these are traders that hold their trades for less than 3 days, and most times 1 day and below. So those are called short-term traders. So if you're a forex trader and you're a beginner trader, you need to look for. You have to decide: are you going to be a long-term trader, a medium-term trader, or a short-term trader? So then we have the medium-term trader. So the medium-term traders are traders that trade between 1 and 4 hour time frame. So they trade on 1 and 4 hour time frame. Then their potential target is 50 to 200 pips for medium-term traders, and their holding time, they hold trades for more than 3 days. Those are mid-term traders. Then we have the long-term traders. So the long-term traders, you can call these the swing traders. These are the ones that hold trades on 4 hour time frames, daily time frames, and then monthly time frames. That's where they trade from. So their potential target is 200 pips, and they hold trades for more than 10 days. So those are the long-term traders. So if you're a forex trader, you need to look out and decide: are you a long-term trader, or are you a swing trader, which is the long-term trader? You can decide to be a short-term trader, a medium-term trader, or a long-term trader. From there, we jump on to technical analysis. So when we reach on technical analysis, now we have really ventured in. Now this is like we have entered in. Now we're going to look at charts. So to understand technical analysis, we need first know what does technical analysis mean. So technical analysis, so this is the framework in which traders study price movement. So this is the framework in which we just study price movements by looking at charts, by looking at the charts. So the idea is that the person can look at historical price movements, and based on the price action can determine at some level where the price will go next. So with technical analysis, we just look at the charts. We can even look at historical past data, that then we can decide where market will go next. This is all technical analysis. And with technical analysis, we have 3 components. We have 3 components that we follow. So when you're a forex trader and you're a beginner trader, focus on 3 components when you're trading technical analysis. So the first component is market structure. What is market structure? So market structure helps you to define the current market conditions so that you know whether to be buying or whether to be selling. So with market structure, you can know when to buy and when to sell in the market. So the first type of market structure is called the uptrend. The uptrend here, we look for only buying opportunities since the market is going to go up and on an uptrend. So this is how an uptrend looks like. So as you can see, when the market is up in an up, like when market is coming up like this is an uptrend. So on an uptrend, and you can see this is New Zealand NZD USD. This is a daily time frame. So in the market, for a market to form an uptrend, it has to form higher highs and higher lows. So this is what I mean. See from here, this is a high low, higher high, high low, higher high, high low, higher high, high low, higher high. So the market keeps on forming a series of these since it's going in an uptrend until the previous high low is broken. So if this high low, if market breaks this zone here and it breaks it, then it means you're going in the reversal. But all you need to understand with the uptrend, and when the market is going in an uptrend, it forms higher highs, high lows, higher highs, higher lows. And how do you trade this market? We have very many videos we have done on the Brazil FX on how to trade this uptrend, but I'll take you through some. So most of the times, since this is a high high and this is a high low, high low, so most of the times the market, whenever it comes to a high low, it's just retesting. As you can see, this is an impulse move. I'll zoom in well so you can see. As you can see, impulse move, retracement. So this impulse move, so we love to take trades whenever the market retraces. So where as the market retraces, look here, this retracement, so meaning we take trades whenever market reaches the swing low, these swing low points. So market comes here, we look for buy. Remember, on an uptrend, we are only looking for buy setups only. We don't look for sells. We only look for buys. So we take trade here, we take trade there, we take buy trade there, buy trade, buy trade, buy trade there. So this is the uptrend market. So if you want to know more about the uptrend market, check out TradingView, and then it will give you more analysis. Then we have the downtrend. On the downtrend, we are looking for sell opportunities. So the downtrend, this is a market that is coming in a downtrend. So how does the downtrend form? When a downtrend is forming, it forms lower lows and lower highs. Lower lows and lower highs. So as you can see, this is Euro AUD daily time frame. As you can see, this is a downtrend. You see market is coming down, but as it's coming down, it has to form a series of, you see here, this is a lower high, lower low, lower high, lower low. The reason why this is a lower low, because it's lower than this one. Then again, this is a lower high, this is a lower low. The reason why this is a lower high, because it's lower high than this one. You get. So this was high, this is now low. So meaning this was a lower high, then this is even a lower high, like it goes down. So these are a series of lower lows and lower highs. So this is our downtrend. Same thing when the market is going down, that's what it forms. But also, how do we trade in a downtrend? So I'm just giving you just a small idea on how we trade them, but we can also go in further and then discover the other ways, support and resistance and all that, how we can trade on these markets. But now, since this is a downtrend market, it forms lower lows, lower high, lower low, lower high, lower high. So since this is a market that's coming down, it has to form impulse moves and retracement. So since the lower lows have to be the longest move, so this is a long move, you see, retracement, long move, retracement. So where do we trade? We only take trades, and remember, we are looking for sell trades on a downtrend. So we take sells whenever market comes here, we sell. You see, when you sell from here, you make money up to here. Then you sell again here, you make money here. But if you have to buy, you buy up to, you can't buy here. So you only want to take, we want to only look for sell opportunities, and we can, so that we can target 100 pips plus, since this is a daily time frame. So on an uptrend, we look for buying opportunities. On a downtrend, we are looking for selling opportunities. Then on a range market, a ranging market is a market that is, forming a series of these highs are equal, and then the lows are equal. So it finds resistance at this level and it finds support at this level. This is what we call a ranging market. So on a ranging market here, we can both buy and sell. It's not like the other markets where you're only looking for either buying opportunities or selling opportunities. So on a ranging market, when price comes to the upper side there, and we see rejection like this, we sell to the downside. Again, when it comes to this level, which is our support zone, we buy to the upside. Again, when it comes to the resistance level, we sell to the downside like that. So a ranging market, we just buy and sell in between levels, but we are doing that as we are waiting for a breakout. So we don't just trade on the ranging market just for the case of buying and selling, but also we trade it while we are waiting for a clear breakout, and then retest, and then we take the trade depending on where the market is going. So if from here we have the simplest concept, and this is the widely used concept by all traders: support and resistance. So what is support and resistance? Support and resistance is an area on your chart where buying pressure would step in. This is what support is. Remember, I have support and resistance. So support is an area where your buying pressure would step in. So as you can see, when you come back here, remember, this is the resistance, this is support. So this is where our buying pressure would step in, you see. But resistance is where the selling pressure would step in to the downside. So I'll show you. So as you can see, this is our nice chart. This is our nice chart. As you can see, we have market coming down here to the support level. But remember here that they're telling us support is an area on your chart where buying pressure would step in. As you can see, price comes here, buying pressure comes in, you see. Buying pressure comes in. So support is just that level where buying pressure would step in. Then resistance is a chart where selling pressure would step in. So the explanation for the support is just the same, is the opposite for the resistance. So this is our resistance. This is our resistance up here, this black line. So here you remember that selling us, it's on the chart where selling pressure would step in. So right now this is our resistance. Now price comes here, selling pressure comes in, you see, it dips. Some here, price dips. But all in all, that's our resistance and support. Then when support is broken, it would become resistance, and vice versa. So let's say if this was our ranging market, and remember, this is our resistance and this is support. So whenever price breaks the support level, it now becomes resistance. That's what you see here. You see price breaks, it becomes now resistance, in a way that price is trying to retest and see if it can come back into this zone, but it fails, where it becomes resistance, and now price comes down like this. So this is what they mean when support is broken, it would become resistance. Then it's just the opposite for when the resistance is broken, it would become support. So this is what they mean. You see, we have a ranging market, ranging. Then after we have a breakout where the resistance is broken, now it becomes support. As you can see, price breaks, then it wants to just find support so that it can keep on going up. So this is support and resistance. This is the widely used concept, the simplest concept to use: support and resistance. We just look for those ways. So there are many ways we can draw support and resistance, but for more research, just check out our videos below and learn how to trade support and resistance. We already have a strategy that we've made on support and resistance. From there, we jump onto the trend line. So I'm just going to give you a few examples on how we trade these markets. So up here you see we have a market coming in an uptrend. This is a market coming in an uptrend, you see. So this market, whenever it comes on this trend line, we buy. You see, we buy. But since this is an uptrend, remember, when an uptrend, we look for buy setups only. We want to look for only buy setups, guys. So as you can see, we don't want to buy here. We only want to buy when price comes up, when it comes here to retest. You see, when price goes up, it comes here to retest, we can buy here. But again, when price comes back to this level, we can buy as we're waiting for the breakout. But you need to confirm with the candlesticks that are happening. Candlesticks, we need to know about the candlesticks so that we can know these candlesticks either show reversal or continuation. So when you can find candles that show reversal here to go back up, you can take the trade. But only here on an uptrend, we are looking for buys, since the market is going in an uptrend. Then on a downtrend, this is a downtrend. So on a downtrend, we are looking for sells. We're only looking for sells and price retests back on the red line, which is our trend line. So a trend line, it shows you where the direction of the market is going. So since this is a downtrend, we are only looking for sells. Whenever price, you see those yellow zones, we sell at those zones. That's why price is retesting on those levels. So So guys, that's the uptrend and downtrend, and also the ranging market. Those are 3 components. We also have the choppy market where we don't trade. So just be careful. The choppy market, we don't trade that because the market is choppy. We only wait for the breakout to happen. So this is the ranging market. Again, we only buy and sell in between these levels for the ranging market. From there, we jump onto the Forex patterns. Since we know now the uptrends, we know the 3 components of the market structure. We know uptrend, we know downtrend, and we know the ranging market. So we are now going to learn about these patterns that we see every day on the market, because these are some of the patterns that are going to show us reversal, continuation, or both. So these patterns, you need to know them also, so that when you find a market on an uptrend, you find a pattern on your market, you know this pattern is for continuation or reversal. So for our first pattern is the double top. So double top is a chart pattern where price reaches a high twice and fails to break out higher during the second attempt. So this is what they're trying to mean. Price finds resistance there, it fails to break, it comes back here to find support, again it goes back to break, it falls. So in that way it forms an M pattern, or which is called the double top. So here we just draw a neckline where price comes back to this level here, then we draw a neckline like this, then we only wait for a breakout, and then we take a trade just here after the breakout, sometimes after the breakout and retest. Then your target, you only measure out the target between here, up here, and this red line, same target you measure out here to take your profit. So a double top is a reversal pattern. As you can see, market comes, forms that resistance, it comes back here, forms here, there's another resistance, it comes back here. So this time around we draw the neckline and then wait for the breakout and take trade. That's our double top. Then the opposite is a double bottom. So a double bottom is a chart where price holds a low 2 times and falls to break down during breaks the lower during the second attempt. So this is where price is coming down like this, it falls to break, then comes here to find support, then it comes back again to break, it falls. So in that way it forms a double bottom, which is called a W, and I know most of you guys consider these as W's, not even as double bottoms. Same way here, we do a neckline between your price, forms this W here, then we wait for the breakout and we take trade. So this is our double bottom. Then from there, that's how the double bottom looks like. You see, market comes, it falls to break this part here, it goes back, it comes again to try and break here, it falls, so it goes and break out, and we go up for a buy trade. So that's also a reversal pattern to the upper side. Then we have heads and shoulder pattern. So heads and shoulder pattern is a pattern described by 3 peaks. You see, 1, 2, 3. So the outside of 2 close in height and the medium is the highest. So this and this one, they're quite equal, but this one is the highest. So it's, as you can see, they form shoulder, head, shoulder. Is it 3 peaks? 1, 2, 3. So here, same way, price is coming in an uptrend form, it gives us that higher high, comes here, find a higher low. When it comes back again, here finds a higher high. Then when it comes down, it breaks the previous higher high, this one, this side, and comes down here again, it forms a high, but now this is a low. Since this is the highest point, now this becomes a high low. So again, when it comes down here, we just want a breakout. So we connect our neckline from this point to this point, we take that side as we are waiting for the breakout. So this is our heads and shoulder pattern. This is a reversal pattern also. So this is how it forms. This is how it forms. As you can see, we have market coming in an uptrend, it forms that, it forms a higher, it forms this one, then after we connect our line from here to this level here as we are waiting for the breakout. When the breakout happens, we take trade. But still, where do we find these patterns? We only find these patterns on bigger time frames. We only look for these patterns on bigger time frames. Then from here we jump onto the inverse heads and shoulder. So the inverse heads and shoulder is just the opposite of the heads and shoulder. So this one, it happens on a downtrend where the market is going to reverse and come to the upper side. So we see market coming down like this. It forms a lower low, a lower high, a lower low. But this amount, when it comes, it breaks the previous lower low, meaning we may see change in structure. Again, when it comes, it forms a low. But now, since this is not low as this, it means this is a higher low. Then price, we see price coming up, but we want to draw a neckline at this point and this point, so that when market breaks out, we take a trade. And we measure our target between this highest point to the red line, same to this. That is our target. So this is the inverse heads and shoulder pattern. Then this is how it forms. As you can see, shoulder, head, shoulder, then breakout, we take our trade. Then from here we have the rising wedge. So the rising wedge, so this is a pattern formed by drawing and ascending trend lines, one representing heights, another representing lows. So this is how we draw it. We draw the one trend line like this, another trend line up here. So when you draw both of those trend lines, they form a pattern called a rising wedge. You can see it's rising, it's going up. So when we have a rising wedge, the market has to reverse and drop to the downside because it's a rising wedge, and that rising wedge represents a reversal. So this is how it happens. You see, we have market coming in an uptrend. So remember, we draw two trend lines like this to form a rising wedge, and you have market falling. And also we can have divergence while trading on the rising wedge. So we have divergence showing market it's coming down like this, and on our pattern here we have market showing that it's coming up. So we have this sign where market showing is coming down. So divergence also is a reversal strategy, or it's a reversal sign. From there we have the falling wedge. Excuse me. The falling wedge is it's a pattern that's formed also by drawing descending trend lines, one representing the highs, another representing the lows. So this is our falling wedge. This is how it forms. Somewhere the falling wedge is a reversal pattern to the upper side. When you say falling wedge, you know market is going to reverse and come to the upper side. So this is where it happens. You see, falling wedge, both are two trend lines. So when you see such a pattern in the market, no market is going to reverse and come to the upper side like this. Another thing, we have divergence. You see, we have divergence. So we have divergence here on our RSI market showing us that it's coming up, and on our market shows it's coming down. So this is divergence, and it happens in the same zone here. So this is a reversal pattern here, and this is a reversal. This is a reversal sign, which is called divergence. So when you see that, which is called the falling wedge, you know market is going to go up. Then from there we have the bullish flag. A bullish flag. This is named due to its similarity to a flag on a flagpole. So this is a bullish flag. A bullish flag forms when when you have this impulsive move to the upside. Then we have this zigzag. You see, zigzag. Then again we have a breakout. So meaning we only want to identify this big move here, then we identify this which acts as our cloud. So here we just draw two trend lines coming to the downside like this. I'll show you. So this is what we want. We want to have this move here, and we want to have market coming like this. So when you have this in the market, we wait for only the breakout. Even recently we had something like a ranging market on USD chef 4-hour time frame. So what made the market break out was the flag. We had the flag pattern, but I don't know if most of you guys saw it. So market broke out and started going up crazy. So something here, when we want to measure take profit, to measure from here to this level up here, something we measure out here for the breakout and take our profit. So this is a bullish flag. Whenever you're using all these patterns, you have to make sure to use stop loss and take profit. If you don't use that, you'll be taken out. The opposite of this one is the bearish flag. The bearish flag is a chart pattern that is formed by two declines separated by a brief consolidating replacement period. So for this one, we have price coming down, you see, coming down, then we have this zigzag. It's like price is trying to retest, to retest, and it wants to go back up, but it falls. Since we draw our two trend lines, so price now starts ranging in between here as we're waiting for the breakout. When the breakout happens, we sell. So the bearish flag, we saw this is a continuation pattern to the downside. As you can see, it happens when price is coming down like this, then we have this retracement. So we draw out the retracement and then wait for the breakout. When the breakout happens, we take trade here and then come down all the way. So most times you measure the distance between here to measure your target, because price has to form this first move, which was its previous flagpole or raise. So take that in mind. Then from there we have the bullish rectangle. The bullish rectangle, this is one of the most simple patterns, forex patterns, because it's forming more of a ranging market. You see, it forms more of a ranging market. I'll show you. You see, the price comes into this zone here, it falls to break, which makes this a resistance level, then comes again here down to find support, which also makes this a support level. So meaning price is ranging, but this is a retracement. But how we call this is this is a retracement, but in the form of a rectangle. So market forms this jumping in between as we're waiting for the breakout. When a breakout happens, we take trade only after the breakout. Don't take trade before the breakout. So that's our bullish rectangle, and you can always measure the distance in between here and here, the two red lines up here and here, to measure your take profit. Then from there we have the bearish rectangle. So this is formed when price consolidates for a while during a downtrend. So we have price coming in a downtrend like this, then it consolidates for a while. You see, after we have a breakout, it's just the same to the range market. We have this, we have the support and resistance. We have price consolidating for a long time, then we have a breakout. So here we only look for sells. See, this is a continuation pattern to the downside for sellers only. So this is how it happens. We have price consolidating for some time, then we have a breakout, and most of these breakouts happen because of these economic events that happen every day. So whenever you're taking these patterns, make sure to look for nice entries, so that when you take the entry, news will complete these structures, or news will complete these patterns. Then from here we have the bullish pennant. So bullish pennant, it's formed during a steep or almost a horizontal uptrend. So the market is in an uptrend like this, it has to consolidate or it has to retrace. So it retraces, but in a way it forms this small triangle, which we call a bullish pennant. This is how it looks like. We have a steep uptrend, then we have market consolidating sideways like this. Then after here we just draw out our triangle like this as we wait for the breakout. And remember, I told you the breakouts happen because of news. You see the breakout, it broke out because of news. So we take our buy trades. Then the opposite is the bearish pennant. So this is formed during a steep, almost a vertical downtrend. So market is coming in a downtrend, and it corrects. So guys, before we go further, make sure to subscribe to this channel, turn on your notification bell, and let's continue with this video. So this is our bearish pennant. The bearish pennant happens because we have this steep move here, then price starts coming in this way. So these are already small patterns. You see, market is coming in a downtrend, then it starts consolidating. As it's consolidating, it's just waiting to break out and continue going down, as you can see here. So this is our last, these are our other ones. This is an ascending triangle, this is a descending triangle. So this ascending triangle, these ones represent both. Market may either continue going up or may reverse and come to the downside. Same to this one, this descending triangle. Price may probably come down or may reverse and go up, depending on where you find it. So when you find this on an uptrend, market will go up, but if you find it on a downtrend, market will come down. But if you find this on a downtrend market, this will come down, but if you find it on an uptrend market, it will reverse and go other side. So this is how it looks like. This is the ascending, this is the descending. Then lastly we have the symmetrical triangle. Symmetrical triangle happens, it's almost the same as the bearish pennant, but for this one, this is a bigger pattern. It forms when market, you know, is jumping in between, same way, consolidating. But all these consolidations happen when we are waiting for breakout, depending on what pattern comes out. So guys, remember, I told you have three components of market structure. Have the uptrend, downtrend, and ranging market. On all of those markets, we find these patterns. And when you find these patterns, you can be able to identify where a market will go next. So guys, I hope you have enjoyed this full course video. I'm bringing more and more quality content for you guys. Make sure to subscribe, hit the notification bell, share with all your friends, because we are going to get rich together. We are going to do this together. God bless you guys. See you.